Hello and welcome to the virtual classroom where today we'll be discussing the accounting cycle further, specifically looking at adjusting entries, posting, and the adjusted trial balance. So we have already seen the first few steps of the accounting cycle. We've done our journal entries, we've posted them, and we have created the unadjusted trial balance. Now it's time to move on to the next two steps. Now, we have to do adjusting entries because GAAP requires that we use the accrual basis of accounting. With the accrual basis of accounting, it is governed by the revenue recognition principle, which says we record revenue when the earnings process is complete, and the expense recognition principle or the matching principle, which says we have to match our expenses in the same period as the revenues those expenses help us generate. So, because of this, we have unearned, prepaids, receivables, and payables. Under the cash basis, cash is king. So expenses are recorded when we physically pay out the cash, or revenue is recorded when we physically receive the cash. This method of accounting for transactions is not in accordance with generally accepted accounting principles. So, because we are using the accrual basis, there are adjustments that we need to make to certain accounts because with the passage of time, we've earned money or there is an expense that we need to record. So there are four types of adjusting entries, and we can group them together based on when cash is actually exchanged. When cash is exchanged, when the transaction happens after cash is exchanged, then we're dealing with prepaid expenses, unearned revenues, deferred revenues. So in this case, we're looking at cash happening first, then the transaction happens. With the other two adjusting entries, those adjusting entries occur before cash is exchanged. So this time the adjusting entries happen and then the cash happens. What is important to note is that cash is never a part of an adjusting entry. The adjusting entry is either happening before cash is exchanged or after cash has been exchanged. So let's look at prepaid expenses first. With a prepaid expense, this is something that we have paid for already, but we haven't received the benefit of using that item. So in this first transaction on July 1, Cool Kicks Company purchased a 6-month insurance policy for $1,200. If we were to do the journal entry for this transaction, it would look like what you see on the screen there. This is not an adjusting entry. Why? Because cash is there. This is one of our regular old transactions that happens during the period. We put this amount, this $1,200, in the prepaid insurance account because we have not used the insurance yet. We're going to use the insurance at some point in the future over the course of the next 6 months. So, of course, it's not an adjusting entry, but we speed up time and it is now December 31st. We are ready to prepare our financial statements. But before we do so, we have to make sure all of our accounts are complete. With the passage of time, we have now used up this insurance policy. So we have to record the expiration of the insurance. Well, if it's a 6-month policy and we got it on July 1, by the time we get to December 31st, we are looking at none of the policy being left. So when we do this entry, we debit insurance expense for the amount that we have used, the full $1,200, and we credit the asset prepaid insurance to take it off the books. As we use up an asset, it shows up in our records as an expense. So that's why we debit insurance expense and we credit prepaid insurance. Let's look at another type of prepaid expense, supplies. On July 1, Cool Kicks purchased $5,000 worth of supplies. So once again, here we are with a regular old journal entry during the period. We're not looking at an adjusting entry here because it's dealing with cash. So notice we are debiting an asset and crediting an asset, which is perfectly fine. Let's speed up time and let's get to the end of the period. And now it's December 31st, and we're ready to prepare our financial statements. And we do a physical count of the supplies. We actually go into the closet and count how much we have left in supplies. And we determined that there were only $500 worth of supplies remaining. So we need to do the adjusting entry to record the usage of supply. Remember that supplies is an asset, and as we use up an asset, we have to expense it. So if we started off with $5,000 worth of supplies and we're left with $500 worth of supplies, that means we use the difference between the two. So we used $4,500. So we do the entry, the adjusting entry by debiting supplies expense and crediting supplies the asset. If we don't credit supplies the asset, then what happens is when we do our financial statements, it looks like we still have $5,000 worth of supplies on our trial balance, and that will show up on our balance sheet. But if we physically counted the supplies and we determined that there's only $500 left, then we have to make sure on that balance sheet that $500 shows up. That's why we do the adjusting entry. Let's look at another type of prepaid, because with all of our prepaids, generally, we are showing that we're using up an asset. So we debit an expense and we credit some type of asset. Some of our big ticket assets, we don't use all up in one period, like buildings, vehicles, construction equipment. In that particular case, we use a process called depreciation, which is a systematic and rational allocation of a portion of the cost of the asset over the life of the asset. So we're showing that we're using the asset up, but we're not using it all up at one time. So let's see this example. On January 1st, Cool Kick purchased equipment for $100,000. The equipment is expected to last 9 years, and it is expected to be worth $10,000 at the end of its useful life. So with this information, we're going to use this information to help us determine the depreciation amount. And the method that we are using, there are various methods, and we'll see those methods at some point in the future. But right now, the method we're going to use is the straight line method. This is where we take the cost of the asset, we subtract out how much we believe it's going to be worth at the end of the asset's useful life, which is the salvage value, and we divide all of that by the useful life of the asset, how long we expect it to last. So given that information, we're going to take the 100,000 and subtract out the salvage value of 10,000 and divide it by 9 years. That gives us the annual depreciation amount that we will record every single period. So again, depreciation relates to our property, plant, and equipment, all of them except for land. When it comes to land, I can put a building on it, I can dig a hole, but I can never use all of it up. So in terms of depreciation, we don't record any depreciation for land. Now, the market values for land will go up and down, they'll fluctuate, but not what we call the book value in terms of the cost of the asset minus any accumulated depreciation. So here is the adjusting entry when we are dealing with property, plant, and equipment. We're still debiting an expense, but we're crediting an asset. It's a new type of asset. Accumulated depreciation is a contra asset account. That means it is an asset account that's linked with another asset, but it does have the opposite balance. So this does have a normal credit balance. And showing accumulated depreciation on our balance sheet linked with our property, plant, and equipment, well, that allows us to show our assets at their book value or the amount that they're actually worth. So I know I paid $100,000 for it, but after using it for a year, I'm saying that the value decreased by 10,000. So on the balance sheet, I will present the 90,000. But in the journal entry, we want to do the journal entry for the 10,000. So things to remember when it comes to prepaid expenses. We're showing that we used up an asset, and as we use an asset, we have to expense it. The adjusting entry will generally look the same in terms of debiting some type of expense and crediting some type of asset or contra asset. in dealing with unearned revenue. With unearned revenue, we receive the money from our customer, but we haven't provided the service. And remember, the revenue recognition principle says we can't record an amount received as revenue until the earnings process is complete. So initially, the earnings process is not complete, and over time, we earn the money. So let's see this example. On July 1, Cool Kicks received payment from one of its customers in the amount of $10,000 before providing services. The payment amount reflects 6 months worth of consulting services. So again, not an adjusting entry because it involves cash. Unearned revenue is a liability, and it is a liability because I owe this amount to my customer until I provide the service. We speed up time. Oh, of course, this is not an adjusting entry. We speed up time and we completed all 6 months worth of consulting services. So now that the money has been earned, we take unearned revenue off the books by debiting the liability unearned revenue, and we credit revenue. So all we're doing is showing that with the passage of time, we've earned the money, we take it out of the liability account, and we put it in the revenue account. So with unearned revenue, you can have unearned subscriptions revenue, unearned rent revenue, just a bunch of different things where we're changing the adjective, but the journal entry or the adjusting entry is essentially the same. We're debiting some type of unearned revenue account, and then we are crediting revenue. So initially, what happened was we received the cash before providing the service, and with the passage of time, we've provided the service, and the revenue has now been earned. If we don't make this adjusting entry, then we end up understating our revenues, which in turn will understate our net income, and we will present ourselves in a worse light. In other words, we won't be showing all the money that we've earned. So just to recap, in this video, what we've seen are the adjusting entries that are necessary when cash has already happened. Either we've paid out cash or we've received cash, and with the passage of time, we've now received the benefit of that particular expense or we've earned the money. Join me next time where I will wrap up the discussion of adjusting entries by talking about our accrued revenues and our accrued expenses. Thank you so much for your time and attention, and I hope you have a wonderful day.